signaled that the upside momentum was still there for US stocks, even with some of the concerns about both inflation and the Fed pushback when it was to early rate cuts. The environment for equities in particular, and even for bonds, is still as being pretty reasonable. That soft landing hope remains in. If it's not exactly the famous Goldilocks moment, it's fairly close. The bears don't seem to be particularly close by, and also signs that the bears aren't particularly hungry right now. So a modest up path for risk assets, with some concerns about commodities. Oil ticked up again, as you mentioned. We're also seeing London metals up a bit, perhaps a sign that at the end of last week, or all week, we saw most commodities come back down after some very big spikes that happened up to that. Looks like they've now stabilized at about the levels they were before those spikes, which is still elevated. Most of the uptrends are still in place, so that retains that concern that is there, that economies are a little bit too strong and inflationary pressures are a bit too strong also for most central banks to relax.
Gav, are we also starting to see perhaps more encouraging signs of improvement and certainly confidence out of China?
Well, China also remains a little bit of an anxious spot. The good news is that the data pulse does seem to have turned around a bit. We had those profits reports yesterday. There's a lot of anticipation that the PMIs that we get later this week will cement the idea that the Chinese economy is potentially gaining momentum and certainly has sort of stopped losing it, as it were. So that's a positive. The other concern, though, is that the real estate, repairing that is a long and difficult path, and there was some very strong gains when the rescue package was first announced, and there are some doubts as to whether you really want to pile in from because you've had those strong gains. Can you get fresh strong gains going forward? We need to see a trigger for that, whether that comes from an actual easing, which is expected maybe early next month, or whether we see some serious progress on those efforts to relieve the glut in housing.
Garfield Reynolds, who leads our Markets Live Asia coverage. And as we mentioned, the sort of positive market catalyst has been China and its creation of the country's largest ever fund to boost the development of its domestic chip industry. And of course, all of this comes as Beijing looks to achieve tech self-sufficiency to bypass intensifying US restrictions. Let's bring our executive editor for Asia Technology, Peter Ahlstrom. And Peter, this, I suppose, aptly named Big Fund 3, really is ambitious. I suppose it needs to be, given that I think when we crunch the numbers, we've seen some $380 billion worth of commitments and pledges and earmarked funds by governments wide. Does this give China a significant leg up in terms of this tech supremacy war when there are such, restrictions in place?
It's interesting to see how these government programs are rolling out in different countries. China, of course, has had a much more proactive industrial policy for many, many years, including in the semiconductor space. They have a program, Made in China 2025, which was aimed at helping them make significant advances in a number of different areas, including biotech and electric vehicles and semiconductors. In addition to that, one of the key questions, though, was how sustainable this was going to be, given some of the economic problems in China. As you alluded to, this is the third fund that's aimed at making investments in the semiconductor area. With some of the economic challenges, including the housing crisis, it wasn't exactly clear whether they were going to be able to continue to fund very aggressively in the semiconductor space. So what we're hearing now is this new Big Fund 3, which is roughly $48 billion, has been raised. It is pulled out. This signals very clearly that for Xi Jinping's administration, semiconductors remain very high priority. And that's partly because the U.S. has been getting increasingly restrictive in selling China the kinds of tools that they need to be able to develop the chip industry, also to be able to get their hands on advanced chips like the AI chips from NVIDIA that are used to train AI models, so important for things in the future.
Peter, we haven't always seen those big fund investments paying off in the past. There's been perhaps a bit of money being misspent. We saw the former boss as well of the big fund investigated for corruption and moved, of course, from his post. Do we understand how this money could be spent differently, or do you think that China's ironed out the issues that they've seen in the past?
Yeah, you're exactly right. The big funds in the past have had some problems, some challenges. The government, Beijing, has not seen the kind of progress in some of the key areas that they like within the semiconductor industry, despite much money being spent in many of these sectors. This is again, a Beijing centralized fund. There's a lot of money being spent by the local governments too, so there's a lot of money pouring into these areas. Where we've seen progress is really the older chip technologies, the legacy chip technologies. We're seeing a lot of fabs being built, a lot of progress being made within China to build that foundational layer. Also, the U.S. has now put restrictions on some of that older kind of equipment, the older chip technology. But at the most cutting edge, it's been a challenge for China. You see, as we saw in the market yesterday after this news was announced, you see some of makers in China, including SMIC and Huahong, make some pretty significant increases in their share price. There's a positive reaction there because investors anticipate that Beijing is going to back these companies. They want to try to develop some of these more advanced technologies, especially 7 nanometer, 5 nanometer, maybe 3 nanometer and 2 nanometer chips, the kind of chips that China no longer can buy from the United States in many different cases, including the NVIDIA chips that we're talking about. NVIDIA has essentially a monopoly on some of those chips that are needed to train the most AI, most advanced artificial intelligence models that are out there. So that's a key area where they want to make some breakthroughs in Beijing.
Thanks, Peter. That was Peter Elstrom, the Executive Editor for Asia Technology from Tokyo. And we're about 10 minutes into the session so far for trading. And some of the names we're looking at in particular today, we just saw lines crossing. Of course, that drop we've got for at the open here. SM Entertainment has initiated a block trade, and they're selling HYBE shares around 750,000 at a discount to the last close price. So that's being reflected in that move you're seeing right now. What else is Daiichi Sankyo? It's developing a drug in partnership with Astra, and we are showing drug has extended the lives of some cancer or lung cancer patients rather. That stock little change at this point in time. Chip stocks ones to note as well, not just for the big fund investment China has made, and we did actually see some Chinese chip makers moving yesterday, but also because we're hearing that Micron is new DRAM chip plant in Hiroshima. That's according to local media. Up next, we are going back live to the UBS Asian Investment Conference in Hong Kong. We're going to be speaking exclusively with the bank's Asia Pacific president. We'll also be joined by the co-founder of SenseTime and the CEO of India's National Stock Exchange. So really news coming up. We'll have much more ahead. This is Bloomberg.